Hi there, everybody. I am Megan Whitland, your mortgage mom, and today we are going to talk all things loan types. So if you've ever heard FHA, VA, USDA, conventional, Fannie Mae, Freddie Mac, what does it all mean? What's the difference between all of those loan types? I'm here to break it down for you today. I'm going to screen share in a PowerPoint for you so we can talk about the main loan types, and we're going to get right into it. So, like I said, I'm Megan, your mortgage mom. I'm a branch manager and loan officer with Fairway Independent Mortgage. I've been doing mortgages for over 10 years. And if you've listened to the media lately, or whether you've bought a house, not bought a house, maybe you're just more interested in learning about the different loan types that are available for you. And these next four I'm going to go over are the most traditional. So I'm going to start with conventional loans. You may have heard of a conventional loan. If you've heard the names Fannie Mae or Freddie Mac and wondered who are these people, those are conventional loan products. So conventional loans are a really popular loan type. It's what a lot of people end up in. Down payment can be as little as 3 to 5%. 3% is more common for first-time home buyers. There's additional programs for first-time home buyers called Home Ready and Home Possible. They're just Fannie Mae and Freddie Mac's version that allow first-time home buyers with certain incomes, below certain income limits, to purchase at as little as 3% down. Traditional down payment is anywhere from 5 to 20% on up. A common myth I hear is I have to have 20% down to buy a house. No, you don't. You can do a conventional loan with as little as 3 to 5% down. Conventional loans do require a credit score of 620 or higher. Why a lot of people say and think you have to have 20% down is because you will have something called PMI if you put less than 20% down on a conventional loan. We love acronyms in the mortgage industry. Now, PMI stands for Private Mortgage Insurance. When you put less than 20% down on your home with a conventional loan, you will have some kind of private mortgage insurance, and this is just to protect the lender in case of default. It's just, think of it as insurance for your loan. When you put 20% or more down, that's less risk to the lender. Therefore, that private mortgage insurance will not be required. Now, keep in mind, private mortgage insurance also depends and fluctuates based on your credit score. The higher the credit, the less risk, the lower the mortgage insurance rate. So your friend may have gotten a conventional loan and might have different mortgage insurance than you because you have different credit scores, risk factors, loan amounts. There's a lot that go into it. Conventional loans do have some flexibility with various properties and terms. You can use a conventional loan to purchase an investment property, a second home, of course, your primary residence, and every loan type has different guidelines, just to be aware. I talked about Home Ready, Home Possible, and Home One. Home Ready and Home Possible limit you to 80% of the area median income where you're purchasing. Now, we have income lookup tools as lenders. We can look that up for you. Don't feel like you have to figure that out yourself. And then Home One actually is a 3% down program that does not have an income limit. But keep in mind, these three programs are for first-time buyers. And a first-time home buyer is somebody who has not had ownership interest in a property in the last 3 years. So if it's been more than 3 years since you've been on the title and owned a home, you are considered a first-time home buyer. So that's a breakdown of conventional loans. Now, getting into FHA loans, Federal Housing Administration. Like I said, we love acronyms in the mortgage industry. An FHA loan has a down payment as low as 3.5%. That is the minimum down for a Federal Housing Administration loan. The mortgage insurance rate is 0.55. So unlike conventional loans, FHA has a flat mortgage insurance rate no matter what your credit score, whether it's 620 or 700. If you're going into an FHA loan, the mortgage insurance rate is that 0.55 with 3.5% down, and that number is reduced when you put 10% or more down. Fairway requires a minimum credit score of 580. There may be other lenders that can go lower, but keep in mind with that, higher risk equals higher rate. I would recommend increasing credit. Oops, I'm getting ahead of myself. Increasing credit to get that better interest rate. FHA loans will have mortgage insurance for the life of the loan. Even if you put 20% down, it will have some type of mortgage insurance until you refinance into a conventional loan with that 20% or more equity. There are certain property standards that FHA requires you to meet. So there's a thing called MPRs, or minimum property requirements. The home has to be safe. The appraiser is going to make sure. They're going to look for things like mold in the crawl space and the attic, severe cracks in the foundation. They will look for certain safety concerns, but they're just minimum property requirements. It does allow more flexibility with debt to income ratio. So FHA is a little bit more flexible with going to a higher debt to income ratio than conventional loans. So it is a little bit easier to qualify for more with an FHA loan in certain cases. And FHA, unlike conventional loans, is primary residence only. Can only purchase primary residence, meaning you are intending to live in the home for at least 12 months as your primary residence. Getting into VA loans, our next type, it's our Veterans Administration loan. VA loans are amazing. I personally love doing VA loans. Of course, they are for our veterans, right? You have to have served at some capacity in the military, and we have the ability to look up to see if you have served in the military. As a lender, I can pull what's called your certificate of eligibility to determine whether or not you are eligible for VA loan. But some of the benefits of VA, there is no private mortgage insurance, no down payment required in most cases. So zero down, no private mortgage insurance, which is an amazing benefit. VA does have, in my opinion, some of the most flexible credit requirements. They're very lenient on certain things. It does go down at Fairway. We go down to a minimum credit score of 580, just like FHA. VA funding fee does apply unless you are a disabled veteran. And that is something the certificate of eligibility, when we look it up, will tell us whether or not there is a disability rating. If typically 10% or more disability rating, the veteran is exempt from that funding fee. Now, the funding fee is financed into the loan. The veteran does not have to pay this out of pocket. So for example, a veteran purchasing their first home, utilizing their benefit for the first time, the funding fee is about 2.15%. That is financed into the loan, not paid out of the veteran's pocket. So it just gets added on in addition to the financing. You can use your entitlement more than one time. One of the most common myths I hear is, I'm saving my VA loan benefit for my dream home. You don't have to do that. You can use it more than once. I'm personally, my husband and I are on our 5th VA loan. So you can use it more than once, and you can carry one more at a time, more than one loan at a VA loan at a time. There's a worksheet we do that can calculate the remaining entitlement that you have that could potentially, so let's say you lived in the home for a year and you're getting transferred and going to a different duty station. You can keep that original home and turn it into a rental. And there's a calculation we do with your remaining entitlement to see how much you can purchase at zero down for a new home. If there's not enough entitlement to purchase at zero down, typically a small down payment will be required, and your lender can calculate that and tell you what it's going to need to be. I recommend all veterans purchase a home at every duty station they go to. It's just a way to build wealth for your family. But VA, like FHA, is primary residence only. You cannot purchase an investment property with a VA loan. You can turn it into an investment property after you've occupied it for a year, but your original intent with the purchase, you have to purchase it as a primary residence and live in it for 12 months. USDA loans. These are kind of your more rural, less populated areas can qualify for a USDA loan. So USDA, like VA, does not require a down payment, but there are income limits to this program. There's an income lookup tool that we use to determine if you qualify or not. And the property location, like I said before, has to be rural or suburban. So there's a map that we use to determine if a property is USDA eligible. So if it's a less populated area, it's definitely worth having a lender like me or your realtor look into whether or not it's USDA eligible. And it does have mortgage insurance, but it is lower than FHA's mortgage insurance. So USDA is a great option if you're looking in less populated, more rural areas. So how do you choose? How do you determine what loan program to use? Consider your financial situation and your credit score is a big thing. Think about your down payment capability. That has a lot to do with it as well. There are down payment assistance programs out there. I'm going to do videos on those coming up here soon. But if you have your down payment saved, a lot of times that will kind of determine what loan program you're going to end up in, evaluate the home you're looking to purchase, and also consult with a mortgage advisor. So it is my job to review your loan application and determine what loan programs you qualify for and give you some options as a consumer and help you pick, because there are hundreds of loan programs out there. I just gave you the 4 most common that we see and the benefits and the basics bullet points of them. So definitely trust your loan officer and advisor to help you determine what loan program is going to be best for you. How to apply or contact me, there's a QR code on your screen, or if you follow me on social media, the link in my bio, you can apply for a mortgage loan on my website, homeloanswithmegan.com. We also have in the link in my bio and on this QR code, home improvement loans, debt consolidation loans, and also home equity loans. The links for all of those are on that QR code and the link in my bio on my Instagram. I'm also going to put it in the notes on this video, but all my contact information is on the screen. Please feel free to contact me anytime. Consider me your resource for all things mortgages and loans. Happy to connect you. If I can't help you, I will find somebody who can. Thanks so much for listening, and tune in next time.